Hey everyone, welcome back to Corporate Decoder, the place where we untangle the complicated world of corporate finance and see if companies are truly putting their money where their mouth is. Today we are diving deep into Bloom Energy's latest quarterly report, and let me tell you, things are certainly interesting. Stick around if you want to know if Bloom Energy is powering towards success or sputtering out. And hey, if you love getting these kinds of insights without all the corporate jargon, make sure you are subscribed. We also have a fantastic community growing on our Discord server, linked in the description below, where we break down these filings even further. So hit that subscribe button and join the conversation. Let us jump into what happened for the 3 and 9 months, ended the 30th of September 2025. So first up, we have a look at their balance sheet. Think of this as a snapshot of what the company owns and what it owes at a specific moment. As of the 30th of September 2025, Bloom Energy's total assets were around $2.6 billion, which is pretty much flat compared to the end of last year. But here is where it gets interesting. Their cash and cash equivalents, that is the money they have easily accessible, dropped quite a bit from over $800 million at the end of 2024 down to about $595 million by the 30th of September 2025. That is a significant chunk of change gone. On the flip side, their accounts receivable, money customers owe them, jumped up by about $75 million. This could mean they are selling more but not getting paid as quickly, or it could be a sign of potential future cash flow issues if those payments are delayed. Their inventories also saw a big increase, going from $544 million to over $700 million. This suggests they are building up a lot of product. Is it because they are expecting a big surge in sales? Or are they having trouble selling what they are making? Now, let us look at what they owe. Their accounts payable, the money they owe to their suppliers, nearly doubled from $92 million to $167 million. This could mean they are buying more raw materials to build all that inventory, or it could mean they are stretching out payments to their suppliers, which can sometimes signal a strain on cash. Their total liabilities actually decreased from $2.07 billion to $1.96 billion, which sounds good, but it is largely due to a big drop in deferred revenue. This means they likely completed a lot of projects where they had received money up front. Finally, let us talk about what belongs to the owners, the stockholders. Their total stockholders' equity saw a healthy increase, going from about $585 million to $677 million. This is a positive sign, showing the company's net worth grew. Now, let us move on to how the company performed financially, their statement of operations. This tells us about their revenues and costs over a period. Get ready for some interesting numbers here. For the 3 months ending the 30th of September 2025, Bloom Energy brought in about $519 million in total revenue. That is a massive jump of over 57% compared to the same period last year when they made about $330 million. For the 9 months of the year, their total revenue was $1.24 billion, up a strong 38% from $901 million last year. This growth is mainly driven by their product sales, which shot up by over 64% in the quarter and 45% for the year so far. But here is the catch. Their cost of revenue, the money it takes to produce and deliver their products and services, also went up significantly. For the quarter, it increased by 46%, and for the 9 months, it rose by 25.5%. This means that while they are selling more, it is also costing them more to do so. Specifically for product revenue, it soared by over 64% for the quarter, reaching $384 million. This is a big leap, and they attribute it to strong demand and better pricing, partly thanks to their joint venture with Brookfield, especially on those major hyperscaler projects. Installation revenue also saw incredible growth, jumping over 105% for the quarter to nearly $66 million. They are saying this is due to hitting key project milestones and better deal pricing. Service revenue grew by about 15.5% for the quarter to $58.6 million, mainly from maintenance contracts. However, electricity revenue took a bit of a hit, dropping 25% for the quarter. They explained this is due to repowering some of their managed services sites. So where does all this revenue and cost activity leave them? In terms of gross profit, that is the money left after subtracting the direct costs of making their products and services. They made $151.7 million for the quarter. That is almost double what they made last year. And for the 9 months, they brought in $347.5 million, a huge jump from $185.3 million. This is mainly because their product gross profit more than doubled. Even more exciting, their total gross margin, that is gross profit as a percentage of revenue, improved significantly from 24% last year to 29% this quarter. And for the 9 months, they are at 28%, up from 21% last year. This shows they are becoming more efficient at turning their sales into profit. But before we get too excited, let us look at their operating expenses, the costs of running the business beyond direct production. These also went up quite a bit for the quarter. Operating expenses jumped by 62.7% to $143.8 million. For the 9 months, they increased by 35.6% to $362.2 million. Sales and marketing expenses, in particular, exploded by over 186% for the quarter and 91% for the 9 months. This is a massive increase, and the company says it is because they are investing heavily in expanding into the data center market and beefing up their support for those hyperscale projects. They are also spending more on employee compensation and benefits, including a significant jump in stock-based compensation, which is tied to their increasing share price. Research and development also climbed by 34.2% for the quarter and 19.2% for the 9 months. They attribute this to more spending on employee compensation and materials for their research efforts. General and administrative expenses also grew by 42% for the quarter and 28.6% for the 9 months. Again, largely due to higher employee compensation, especially stock-based compensation for executives. Speaking of stock-based compensation, it shot up dramatically. For the quarter, it went from $17 million to $38.1 million, a 123.7% increase. For the 9 months, it more than doubled from $55.3 million to $100.5 million. This reflects the granting of new equity awards and, importantly, the rising value of Bloom Energy's stock. This is a significant cost that impacts their bottom line. Now, looking at other income and expenses, there is a really significant item here. For the 9 months ending the 30th of September 2025, they reported a loss on extinguishment of debt of $32.3 million. This happened because they swapped some of their older, lower interest debt for new higher interest debt. While it might seem like a strange financial move, they are likely doing this to manage their debt maturity profile, or perhaps to secure more favorable terms for the future. Also, for the 9 months, they reported an equity in loss of unconsolidated affiliates of $19.6 million. This relates to their new joint venture structures with Brookfield. Essentially, they are partners in these ventures, and while they are not fully consolidating them, they are accounting for their share of the losses from these partnerships. With all these increases in operating expenses, it is no surprise that their total operating expenses for the quarter went up by over 62%. This means that while their revenue is growing rapidly, so are the costs to support that growth. All of this leads to their net loss for the 3 months ended the 30th of September 2025. Their net loss was $23 million. This is actually an improvement from the $14.6 million loss they reported in the same period last year. For the 9 months, their net loss was $88.5 million compared to $132.3 million last year. So, on a net loss basis, things are getting better, but they are still losing money. This translates to a net loss per S-share of $0.1 for the quarter and $0.38 for the 9 months. While the loss per S-share improved compared to last year, it still reflects the fact that the company is not yet profitable. Let us check out their cash flows. This is super important because we want to see if the company has enough real cash to keep the lights on and grow. For the first 9 months of 2025, Bloom Energy used $304.1 million in cash from its operating activities. That is a slight improvement from the $392.2 million they used in the same period last year. This improvement might be due to better cash management as they grow. However, a significant chunk of this is tied up in their working capital, particularly a $179 million increase in inventories. Again, that points to them building up a lot of product. Their investing activities used $58.3 million for the 9 months, mostly for capital expenditures to boost production capacity and for those new investments in their joint ventures. They are clearly investing in future growth. On the financing side, they provided $37.5 million in cash. This is a big drop from the $244.4 million they brought in last year. The main reason for this decrease is that they did not raise as much money through debt offerings this year. They did, however, get $50 million from issuing common stock. Looking at their liquidity, they had about $595 million in cash and cash equivalents at the end of September 2025. They say this, along with cash generated from operations, should be enough to cover their needs for at least the next 12 months. But they also acknowledge that if they need more money for growth, they might have to look for more financing through equity or debt. This is a classic trade-off many growing companies face. Now, let us talk about the overall strategy and risks. Bloom Energy is really leaning into the AI data center boom, seeing it as a major growth driver. They are highlighting how their systems can provide reliable power quickly, which is crucial for these centers that need power fast. However, their massive increase in sales and marketing expenses shows they are investing heavily to capture this market. This aggressive spending is a bet on future growth, but it also puts pressure on their current profitability. They also completed a debt exchange where they swapped some of their older debt for newer debt, which resulted in a $32 million loss. This is a complex financial maneuver, and while it might offer some benefits down the line, it's a hit to their current income statement. A significant risk they point out is their increasing dependence on the AI tools market. If AI adoption slows down, or if data centers do not grow as expected, it could really hurt Bloom Energy. They are essentially placing a big bet on the AI revolution. You also see a huge spike in stock-based compensation. This is partly because their stock price has gone up, making their employee stock options and awards more valuable and thus a bigger expense for the company. While it can be a good way to motivate employees, it is also a substantial cost. So, what is the big picture here? Bloom Energy is definitely growing and their revenue numbers are impressive, especially from product sales. They are also showing improved gross margins, which is a good sign of efficiency. However, their operating expenses, particularly sales and marketing, are growing even faster, and they posted a net loss. Their large inventory build up and increasing accounts receivable also warrant close attention. They are also heavily reliant on the booming AI data center market, which is a double-edged sword huge opportunity, but also a significant risk if that market cools down. The company is making strategic financial moves like debt exchanges, which can be complex in their stock. Based compensation is a considerable expense. To put it simply, Bloom Energy is in a high-growth, high-spend phase. They are investing aggressively to capture a massive market opportunity, but they are not yet consistently profitable. Investors will be watching closely to see if their rapid revenue growth translates into sustainable profitability, and if their heavy investments in sales and marketing will pay off. That is our dive into Bloom Energy's latest report. What do you think about their strategy and financial performance? Are they on the right track? Or are there red flags we should not ignore? Let us know in the comments below. And if you found this breakdown helpful, please give this video a like and subscribe for more corporate deep dives. Don't forget to join our Discord community, linked in the description, to continue the conversation. Thanks for watching, and we will see you in the next video.